The purpose of this webinar is handling the complex US topics. Okay. So we are covering mostly the complex topics, right? For taxation, and that
Mhm.
will help someone in the US as well, someone in the India as well, the students, staff, people working in the industry, and also the chartered accountants. Okay, in the India who
Mhm.
wanted to explore the opportunities with the US tax and accounting. If they wanted to start something at their own or wanted to explore or serve their clients in the better way, because a lot of the Indian CAs, they are handling the NRI taxation, okay, for their clients. And if they know the US taxation in better way, they can serve their clients in the right direction. So that is also the purpose of the webinar.
Mhm.
And the next topic that the April, okay, will be covering, that is again the very, very interesting topic, okay, that I will announce, okay, by end of this webinar.
Sure, sure. True means whatever you just explained, Vivek, it's true. And as I told you earlier as well, the last webinar was a great success, and we have received a lot of comment explaining how things have helped, how your education has helped them. And yeah, I expect the same from this. So let's start if you guys are ready.
Yeah, let us start, okay, because a lot of slides to cover, okay. So
Yes, yes, it
if
is.
people are joining late, let them allowed to join, okay. But
Okay.
they can see always the recorded session. Yeah,
Yes.
we can start.
Okay. So good morning, good evening to everyone in whatever geography you are, to all the attendees. Welcome back. Following the success of our last webinar on non-resident taxation in the United States, today Vivek Shah and Manshi Shah will provide us with useful insights on international taxation, US citizen and green card holders, also known as resident alien this time. So over to you, panelists.
Okay, thanks, Abby, for the introduction, and good morning and the good evening to everyone here. And as you know, we finished non-resident alien taxation in our last webinar. And I hope you learned a lot and enjoyed totally that webinar. The recording of that webinar is also available in our Smart Accountant YouTube channel. So if you want to refer, feel free to refer that. And let us start the presentation. Okay, thanks, Mansi. Okay, Mansi will be covering the few portion. Okay, later on. So let us start the our presentation. Epi, you can move to the slide number 2. This is the overview. Again, the today's topic is very interesting topic, and this is what I did for the almost my 20 years careers. Okay, US citizen and the green card holder with the international nexus, global reporting, and this is the very hot topic nowadays. And very interesting, and we all know the international taxation mostly handled by the top 100 accounting firm. Since I worked 15 or 16 years with the large accounting firm, so I got the opportunity to work on the international taxation side. That is the more coverage, that is the more coverage area on today's webinar. Okay, so the definition, FBARs, foreign tax credit, foreign income exclusion, US source income, overview of the individual partnership and corporation, the overview of the complex informational tax return like a 5472 and the 5471, streamline package, very hot and very interesting. Then last, okay, the great planning for a US citizen and the green card holder comes for a estate, gift, taxation, and the exit tax. Okay. Exit tax is again also the very interesting tax levied in the US history. Okay. So, Epi, we can move to the slide number 3. Quickly, I'm covering the definition because this is the same definition that I covered in my first webinar. green card holder and the citizens. Okay, so who is the resident, who is the non-resident? Again, it depends on the three tests. If you are a citizen, then you will be considered as a US resident. If you are a green card holder, you'll be considered as a US resident. Irrespective of the number of days spent in the US, you'll be considered as a tax resident. And third, if you're not a citizen or not a green card holder, then the physical present test. If you meet that test, then you are a resident. Otherwise, okay, if you are not a citizen, green card holder and not meeting the physical present test, you will be considered as a non-resident for the tax return. Definition is very, very simple. Resident, three criteria: citizen, green card, and the physical present test. Then whoever is not a resident, they will be a non-resident. Okay. And the taxation rule, source of the income, everything. Okay. First determination point for the any filing is resident versus non-resident. Okay. Abby, can you just move to the next slide, or maybe you have questions? Yeah, very good question. So I request you to raise the poll and let our audience reply to our questions. Okay.
Wow, so around 80%, 81% people think that the resident is the correct answer. B.
Answer B, right?
Yes. They're still voting.
Yeah, let them vote. Okay. Done, Abby?
Yes, I think so. Yes.
This
So
is not a simple question, okay? Maybe you're surprised with my answer, but this is not a simple question. It took me 10 minutes to frame this question.
Oh. Okay, so 80% think it's B answer, resident.
Okay, okay. So those 80% are correct. Okay, the most likely answer in this scenario will be a resident and or resident unless we claim the treaty-based position. So I'm not denying because hardly the few people know that I'm going to discuss in this explanation of this question. Okay, but I agree. Okay, green card holder living in the India due to Indian income tax rule, they consider as a resident. But as you know that the citizen and the green card holder are inherently a resident of the America. So in my view, those kind of the people are a dual resident. They are the Indian tax resident as well as the US tax resident. But, okay, there is a treaty. Okay, there is a treaty between the India and USA, and this is called as a tiebreaker rule. So as per the one of the article of the treaty, it says whenever the person is a dual resident, it is called as a tie. Okay, and we have to make the tiebreaker rule. And the what the tiebreaker rule says, okay, you have an option to treat one country as a resident and the second country as a non-resident. How to determine that? Based on your closer connection. So if we claim that we have a more closer connection with the India, then we can treat India as a resident and US as a non-resident. If we see that the more closer connection with the US, then we can claim US as a resident and the India as a non-resident. But as I mentioned, treaty is always the optional. In the normal rule, you are a dual resident. You have to file the resident tax return in India. You have to file the resident tax return in US. And both the country, you have to report the global income and take the benefit of the treaty to avoid the double taxation. But for a green card holder, because treaty applies only to the resident alien and the green card holder is considered as a resident alien, taxpayer has an option under the treaty, under the tiebreaker rule, to treat the US as a non-resident. Okay, so more correct answer B and C both are correct, but the right answer and the more correct answer is the C, resident, unless we claim the treaty-based position. Clear? Okay, very good. Move to the next slide. Pre-immigration tax planning. Tax planning must be the part of the person immigration process in order to adverse the tax situation. This is very important. Okay, most of the people, they are in the craze of the getting the US citizenship or a green card, but it never be a fun to hold the green card. Okay, so we have to plan in the well in advance before you get the green card, before you get the stamping in the US, certain assets, certain income. Okay, we have to plan through the HUF trust and so many other ways to make sure, okay, you don't face the adverse tax situation once you get the green card. So pre-immigration tax planning is very, very important if someone is moving from the foreign country to US through the various visa available, H1B, L1, green card, or a citizen. Okay, that is very important because all we know, if you are a US tax resident, you have to offer the taxes on the global income. So whether it is a US source or a foreign source, once you are a resident, source is not important at all. Okay, you have to offer the taxes in the US. Okay, and to mitigate that, to avoid the adverse tax situation, pre-immigration planning is very, very important. If you can move to the next slide, please. Source of the income I discussed in my non-residency webinar as well. Foreign source income and the US source income, IRS has a very defined rule. But if I am a citizen or a green card holder, both the incomes are taxable on my resident tax return. But the foreign versus US definition will be very important when I claim the foreign tax credit, when I claim the foreign non-income exclusion that applies only to the US citizen, green card, or all the other resident. So source is again necessary for the citizen and the green card, but yes, whether it is a foreign source or a US source, it will be a part of your individual tax return, resident tax return form 1040. We all know, okay, we discussed in the previous webinar how to decide the source. IRS has a very detailed definition for each and everything, for each and every type of the income, whether it is a foreign or a US, how to determine. Okay, so quickly I can ask Epi to move to the next slide, please. Okay, again, foreign bank and the financial account. I think that the most of the people who are working in this industry, they are aware the FBARs that applies to the US citizen and the green card holder or all the other resident. Any US citizen or a green card or other resident, okay, having the financial interest in the foreign financial assets. Foreign financial assets means US citizen or a green card holder having the India bank account, NRE account, NRO account, or maybe other type of the account, mutual fund investment, DMAT, LIC policy, everything, okay? It is subject to a foreign assets definition. It has to be disclosed with the US Treasury Department with the FIN Form 114, that is called as a FBARs. Also, the second disclosure is required with the Form 8938, which has to be attached with your main tax return Form 1040, and it has to be filed with the IRS. So two disclosures are required, one with the IRS through the Form 8938, second with the US Treasury Department through the Form FinCEN Form 114. Guys, this is the informational return. It doesn't have any impact on your taxable income. It is just the disclosure of the balance. You have to just pick up the balance, the maximum balance during the year. You just pick up, just report the name of the bank, account number, value, etc. on the FBARS form. It is the informational return. But not filing the informational return, okay, it's costing a lot to the client. There is a huge penalties available, not disclosing the foreign assets on the FBARS form. as well as the Form 8938 with the IRS. So those forms are informational in nature, but is very, very important for our clients. So any of our clients having the international nexus, having a bank account or a financial assets in the home country or their native country, we have to ask the question that please make sure you don't have a bank account, mutual fund, demat account. If someone is living, this kind of the question is very, very important, because the common mistake that I can see that in the domestic CPF filing, or maybe clients are making the mistake, they just forget. Okay, and we all know, okay, since 2015, we have a FATCA agreement signed with the US government. When the Obama came to the India and he signed the treaty with our prime minister, we all know, okay, how these forms become a very, very important as far as the disclosure are concerned, because now both the country are sharing the data for each other citizens. Okay, and that is how the FATCA came into picture. And after the FATCA, it's never be advisable for our clients to hide anything. Okay, just report everything to the US Treasury. If they catch you, the penalty is very, very high. It is the 70% of the value of the assets in the foreign countries. So it is a huge, and the criminal penalty up to 8 years of imprisonment. That is again the very, very weird. So just make sure if you're preparing a tax return for your client, having the foreign financial assets, you properly report on the Form 8938. Also, you properly report with the US Treasury Department on the FinCEN Form 114, because those are the informational form, but not filing those form will cost you a much to our client. Okay, so this is about the foreign bank and the financial account. Due date is again the 15th April, but it is the auto extended. So in real world, when I say the due date, it is the 15th October. So we have to file the FBARs before the 15th October, and you all know the 15th October is the extended due date for the individual tax return. So tax return and the FBARs both are due on the same day. Make sure you include in the tax return when our clients are having the foreign assets. Okay, and mainly if clients are having the foreign assets and their total value is more than $10,000, it is very, very important that we disclose with the IRS and the US Treasury Department. Okay, now I can ask AP to move to the next slide, please. Okay, now the three slide, okay, I'll be covering very fast. Very, very important for any US citizen and the green card holder having the international income. If US citizen and the green card holder living in the foreign country, to avoid the double taxation, okay, they have a one provision called as a foreign tax credit. As you know that in our first example, if I don't take the TT-based position, then I'm filing as a resident in my first question. Then I am a dual resident. I am Indian resident. I am filing the India global income, US global income. Does it mean I need to pay the taxes in the both the country on the same income? My answer is no. There is a very good tax provision available, foreign tax credit from 1116, that eliminate the double taxation. Okay, so foreign tax credit is available only on the foreign source income. So if you see my first webinar, the source definition, if income is coming under the foreign category, and if you're paying the enough taxes in the foreign country, whatever the taxes you paid to the foreign country like India, it is fully creditable against the US tax liability. So if you're paying in India, for example, US citizen living in India, having the salary income from India, okay, on Form 16, they paid the 33% tax. Again, they are including the same salary income in the US because they are the global reporting. Okay, they have to offer the same income in the US. whatever the taxes they paid in the Indian government is fully creditable against the US tax liability. And you know, okay, the tax bracket is little bit less in the US. So most of the time, those people, after claiming the foreign tax credit here, they will be not end up with any additional tax liability in the US. Okay, this is how the foreign tax credit works. This is very, very important provision for the any citizen or sorry any US citizen or a green card holder having the foreign source income. So this is very important. Foreign Form 1116 foreign tax credit has a different category, but the main category is the general category and the passive category. So you know the passive income, capital gain, interest, dividend, royalty, this kind of income is always the passive income. The general category income like a salary income or a business income or a profit from the partnership, or I can say the earned income, those are in the general category. Individual return, we have to file the form 1116. For a corporate, we have to file the 1118. Okay, Epic, you can move to the next slide, please. Then apart from the foreign tax credit, sometimes you have an option. You can take the form 2555 foreign earned income exclusion. Two things very quickly. This applies only to the earned income, means the salary income, business profit, and the business profit, and also the profit from the partnership firm. Something is earned. It doesn't apply to interest, dividend, capital gain, passive type of the income. Okay. So when we have a earned income, this is the totally exclusion. Okay. This is not the claiming the credit. There is a limit given. Okay, the qualifying person, you can see the 2022 limit is the 1,12,000 per qualifying person. Married filing jointly, it is the 2,24,000. It applies only to the foreign earned income. It doesn't apply to the passive category. Now in the next slide, okay, how we decide which one is beneficial to our client, whether we should claim the foreign tax credit or a foreign earned income exclusion or all. Okay, Abhi, next slide, please. Okay, yeah, you can skip that side. Okay, this is the definition which I discussed. Earned income is the salaries, wages, commission, business profits, and the earned income is mostly a passive kind of the income. Variable income is sometimes it is passive, sometimes it is active, like a business profit, rent, and royalty. But the foreign earned income exclusion is only available to earned income. Foreign tax credit is available to whether it is earned income or unearned income, it is available. Okay. Maybe next slide, comparison between the 1116 and the comparative form 2555 and the form 1116. Form 2555, again it is the totally exclusion, but the maximum cap is given. Foreign tax credit, there is no cap. Tax credit is just like getting the credit for the taxes paid to the foreign country, where the earned income exclusion is excluding totally from the income by filing the form 2555. Now the question raised, how it will be beneficial? Simple rule, okay? If the foreign country tax liability or a tax slab is on higher and the US tax slab is on lower, okay, it is always good we claim the foreign tax credit rather than foreign earned income exclusion. For the reverse situation, okay, if someone is living in the tax exempt country, okay, and there is no tax in the foreign country, or there is very, very little tax in the foreign country, so it doesn't make sense for me to claim the foreign tax credit because there is no sufficient tax liabilities available. In that situation, for that client, I may go with the 2555 foreign earned income exclusion because that is giving the more benefit to my client. So I will not go for the 1116. Sometime we claim both, not on the same income, on the other income. Okay. So if the foreign earned income is 200K, maximum exclusion is only 1,12,000. So I exclude 1,12,000. Remaining 88,000, I will claim the foreign tax credit. Okay. So it is all about the great tax planning involved for your clients. But the 2555 and the form 1116 are very, very important as far as the US citizen and green card holder with the foreign income is concerned. Okay. The Next slide, Abby, for questions. Then I will switch over to the Mansi. Okay, now this is very good. Please raise the poll. Okay.
I see here a tie going between B and D, but people are voting. So either B or D, Form 22555 foreign earned income exclusion, or Form W2 US income fully taxable in USA and need to be offer taxes in USA. So let's see. They're voting.
Yeah, it is. This is again the very tricky question and the very
Yeah.
interesting question. So let the people finish their voting, then I will explain the what is the right answer and the approach for that right answer. Okay.
Okay. Okay, so 51% of our attendees feel that Form 2555 foreign earned income exclusion is the correct answer. 50% people. And oh, they're still voting. Okay. And okay, 55% feel that. Oh, okay. They're still voting. All right. I'll give them some few more seconds to vote. Okay, so 54% feel that Form 2555 foreign earned income exclusion is the correct answer. And 36% feel that Form W2 US income fully taxable in USA and need to offer taxes in USA is the correct answer.
Okay, let me explain. I think that yes, they are on the right track. Okay, yeah, I can see the result. Okay, excellent, excellent. Abby. So let us go with the different approach. Why not A? Doesn't make sense for me to claim the foreign tax credit. Is living in the Dubai and Dubai has no income tax. Okay, so what I can claim foreign tax credit? Nothing, right? So A never be answer. C, since the service performed in the Dubai, this is the foreign source income and it's not taxable, but there is the citizen. He's the citizen and the green card holder subject to a global reporting. Okay. So he's subject to a global reporting and it doesn't make any difference whether it is a foreign source or a US source. It has to be offered. Okay. This is not a non-resident taxation. This is the US citizen taxation is subject to a global reporting. And the C is not a correct answer. D, Form W2 US income fully taxable in the US and need to offer. Again, this is not the right answer. Okay. It doesn't make any difference whether it is a US income or a foreign income, whether it is reported on the W2, then you have to offer the taxes, you can't exclude. Definition is very simple. Okay, being a US citizen and the green card holder, you have to report the global income. So income must be included. One thing is very clear. Okay. Now question arises whether I should claim the foreign tax credit or a foreign earned income exclusion. As I mentioned, if someone is living in the no tax paying country like a Dubai or a less paying tax country, it doesn't make sense for the foreign tax credit. I will always go for the foreign earned income exclusion. In that way, someone US citizen living in the Dubai, enjoying the no tax in the Dubai, also excluding from the US tax system. In that way, he's enjoying the entire earning tax free globally. And that is the B is the correct answer. I can ask the Abby to move to the next slide, please. Okay, and I think that the Mansi, you can take it from here. Okay.
Thank you so much, Vivek, for the great explanation. So now we are moving ahead for the filing forms requirement for all the green card holder or citizen or the domestic entities. So first, one by one, we will move to the next slide. Can you move, please? Okay, so to start with the individual filing for the US resident, the Form 1040 that we are using. And as we discussed earlier that we need to report global income in the Form 1040. That is the due date for this year is 18th April and the extension of 6 months is available. And it is similar form for the people who are 65 of the age or older. They can report their income on the Form 1040 SR. It is very much similar form. There are not significant changes, but just the 65 of old people can report their income on that form. So let's move to the next slide. Happy? Okay, now the US trust and estate. So it is basically the separate legal entity for the federal tax purpose. Domestic estate or trust, they have to file Form 1041. And the descendants estate comes into existence at the time of death of the individual. Trust can be created during the lifetime of the individual, but they need to file the form with the department. Let's move to the next slide. We can, okay, great. Okay, so now this is the domestic partnership. So this is basically the informational form because partnerships are not getting taxed by itself. That means that this is pass-through entity. All the partners of the partnership firm, they will be receiving the K1s for the share of income or losses that is pre-decided based on the agreement, and then all the partners will report the profit or loss on the partnership in their individual tax returns. So that is why we call it as a flow-through or pass-through entities. Let's move to the next slide. Now, similar to the domestic partnership, this is the US person who has the partnership share in the foreign partnership. So this is also again similar form of 1065, but in this form, the foreign partnerships profits and loss are reported. Also, the scenario will be very much similar. They will be routed through K1 to the each partner's individual share. And then partners will report on the 1040 on the respective tax form, and they will pay taxes on their respective tax returns. Let's move ahead. Okay, now the next part comes is the corporation. There are two types of corporation. One is S corporation, the second one is C corporation. As corporation, we can say that it is very much similar to the partnership because again, it is not getting taxed by itself. The K1 flows through to the shareholders. There are certain criteria that what entities we can elect to be taxed as corporation that we will discuss later. C corporation, the tax rate is 21%. It gets taxed directly on their profit. Let's move further. Okay. Again, this is the same thing that I have explained. I'm going to discuss very important topics in next slides. Happy, can you move, please? Okay. Form 5472. So this is basically not very common form. This is for the, again, informational return for the 25% foreign owned corporation or the foreign corporation who is doing business in US. So basically there are reportable transaction that we call that any commission paid or anything, services are performed by foreign entity for the US entity. So all this information or all these transactions are getting reported on Form 5472. We have defined the foreign shareholder who is having the 25% of the, at least 25% of the ownership in the US corporation. So that includes direct as well as indirect ownership. So that's why we call it as a related party, right? So corporation 25% owned, if it has at least one direct or indirect 25% shareholder at any time during the year, then this is the filing requirement. Again, even if this is informational return, failure to find this Form 5472 that implicates the very, very filthy penalties, that is the $25,000. And that is why it is very important to keep in mind whenever there are foreign-owned entity, foreign-owned US entity, we need to make sure that reportable transactions are reflected in the form 5472. Again, it does not matter that 4 or 5 person are combinedly holding 25%, then it is not required. We will determine separate 25% holding requirement, and for each such holding there will be the separate form 5472. You can move to the next slide. Okay, 5471, we can call it information return, but now with the introduction of the GILTI tax in the Tax Cuts and Jobs Act in 2017, there is again a separate provision that we are going to discuss. So this form is like US person having the more than 10% of ownership in the foreign entity. So that includes by voting or by value. So they have to file form 5471. What all factors we are going to include and what are the categories that we are going to see in the next slide. So basically, the requirement arises when the US shareholder has 10% or more voting power, or any US citizen who is officer or director in the foreign corporation in which any other US person has the stock of more than 10%, or the person who is already having the 10% stock and that becomes the US person during the year. So these are the separate categories to determine the filing requirement of the form 5471. Again, how will we report that? So basically, whatever foreign corporation that comes under this criteria, we are going to take the financials of that corporation. We are going to report those financials in the USD in the form 5471. And based on that, let's say one US shareholder is having 90% ownership in foreign corporation, right? So whatever foreign corporations profit and loss account or whatever financials there are, we will allocate 90% of the income in the GILTI, that we call it a global intangible low tax income. And on that part, again, US shareholder can claim the foreign tax credit that we have already discussed earlier on this slide. So there are basically two separate things. There is a GILTI tax inclusion, that all the income, all the allocated income in the proportion of the US shareholders holding in the foreign corporation, that we will include in the GILTI calculation, and proportionate foreign tax credit can be claimed. Or there is a second scenario when section 962 of the IRS says that you can elect the foreign corporation to be taxed as a US corporation. That means on all the profit of the foreign corporation, you can pay 21% tax, that is US corporate tax. And after that, whatever dividend distributions are there from the foreign corporation, that US shareholder will have to pay tax on that. So that is why the CPA advisory comes into picture, when you have to determine that whether you should elect 962 election or not. Again, depends on case to case. We have to evaluate all the facts to determine this criteria. We can move to the next slide. Okay, the poll question about the form 5471. Can we raise the poll? Okay. Happy, how we are doing on this?
Yes, we are doing good. So 66% people think B is the correct answer. So whether US person or US corporation says in a foreign corporation during that year is the correct answer. But they're still voting. You'd never know.
Okay.
Some of them think that both A and B are correct. And none, okay, so some also think that A is the correct answer.
Okay.
They're still voting, so let's wait for a few more seconds and see. Okay, so 73% of people are attendees, they think that B is the correct answer.
Okay, that's great. That's the right answer.
Yeah. Okay.
Excellent. That's great. Okay. Let's move further on this part. Okay. Form 3520, informational return for the foreign trust with the US owner. So whenever there is a US person who is having the trustee of the foreign trust, they have to provide the informational return to the IRS by filing Form 3520. The IRS has recently made the exclusion for certain trusts to file this form that includes the educational purpose, medical or retirement funds. This is again the informational form. The due date is third month of the 15th day of the third month. We can move to the next slide. Okay, now this is very interesting topic, the streamline package. So basically, streamline package comes into picture when there is a for the taxpayer who are late in the filing with the IRS, or they have not reported global income, or they have missed the filing. So we already know that US person need to report the global income to the IRS. So when some people or some taxpayer are not aware of the fact about that and they only report the US income, so that is where the domestic streamline domestic streamline offshore procedure comes into picture. When even though the tax returns are filed, but it was filed with US income only. So what we do, we have to go back 3 years. We have to amend those 3 years return to include global income. Again, we can take the foreign tax credit and 2555 that we have already discussed in our earlier slide. And that is where we can go to the IRS saying that, we missed out this filing and we are now correcting this by filing the 3 years back returns. There is a 5% of penalty on maximum amount of foreign assets. So obviously, I mean, whenever we are reporting global income, we need to report FBAR as well. So 3 years tax return filing, and FBAR can go back up to 6 years to the BSA website. On that maximum amount of the balance on foreign bank account reporting, we have to pay 5% penalty on the domestic streamline offshore procedure. Similar concept is the foreign streamline offshore procedure. This is for the people who are US citizen and who are residing abroad. And they are under impression that because they do not have any US income, they do not have to file tax return, which is not correct. Once you become the citizen, once you fall under the tax residency criteria, you have to file the tax return, you have to file the FBARs. So that is why we call it a foreign streamline offshore procedure. Then we can file the 3 years tax return, we report the income, and we go back 6 years to report the FBAR. We can move further to the next slide. Okay. One question, please, again. 5% penalty is applicable in which streamline procedure? Domestic, foreign, both, or none?
Oh, so they've already, almost everyone, okay. Some of them think that it's both A and B. Some of them think it's B, foreign streamline offshore procedure. Some of think A is the correct answer. Okay, they're still voting. B and A, it's a competition between B and A.
Okay.
Yeah. Okay, now some of them are thinking both A and B. Oh, I think this is going to be a tie. But
No one is for the none of the above, or
no, so no, none of the above. I think we need a better fourth option from next time. Oh no, now there is none of the above as well.
Oh wow.
maybe
That's
someone
still
listening me very clearly.
Yeah. Can you get the result?
Yeah, so okay, almost everyone has voted till right now. So most of them think that a domestic streamline offshore procedure is the correct answer.
That's right. That is the one.
Okay.
Okay, let's move further.
Okay.
Okay, Vivek bhai, over to you.
Yeah, thanks, Mansi. Covering the very complex topic like a 5471 and the 5472. This is the frequently asked forms in the each and every US citizen tax return having the international exposure. So still we have a 15 minutes. So let me cover up the 3 or 4 slide, but the again very interesting slide for you people. Treaty, as we all know, the treaty is very, very important. Okay, you have seen in the my one of the question for a tiebreaker rule. Okay, for the green card or a citizen. Okay, treaty doesn't apply to the citizen because treaty applies only to the resident alien. But the green card holder, my question. Okay, in sometime treaty is more beneficial. Okay, but as I mentioned in the my first webinar, treaty is always optional. We can opt for the treaty only if it is beneficial to my clients. Okay. And to claim the treaty, you have to file the Form 8233 with the IRS to claim the treaty based position. Otherwise, your claim is not valid and IRS will go with the normal code of the section unless you file those form and claim the TT-based condition. In the first lecture, I have covered United States are having the treaty with so many countries, okay? So whenever you have a client or if you're working on the tax return, and if you're seeing that the some of the tax provision is just hard for our taxpayer, always keep habit to read the treaty. Sometime maybe a treaty does the wonders and more be beneficial for our client. Okay, so take the treaty based position whenever something is coming, is taxing in the both the country and there is no other provision that is eliminating, always feel free to check the treaty. If treaty is there, okay, and if it is a beneficial to our client, go with the treaty. Okay, file the form 8233 with the IRS and claim the treaty based position. So Abby, can you please move to the next slide, please? Again, the very interesting topic and the very favorite topics for me is the estate gift taxation. This is the big area of the planning is available as far as the estate and gift taxes are concerned. Any US citizen or a domicile or a long-term resident or a green card holder are always facing the difficulty. If something is coming for my clients, if client is asking why I'm just getting the family green card, do I proceed further? Someone is just coming to me and asking that the by EB5 is very, very hot nowadays. I have a lot of money here in the India. Can I go with the EB5 and get the green card? I always say stop. Okay, let us evaluate. Okay, it never be a fun to get the green card. There are a lot of tax liability attached with the getting the citizenship and the green card. Mainly the estate tax that is not in the India. Estate tax is the debt tax, and we all know for each and everyone that is certain. Not today, maybe tomorrow it will come. Okay, and at that time you are subject to estate tax that is very, very huge, 40% of your wealth, whether it's the jewelry, car, home, land, financial asset, everything. 40% goes to the US government as a estate tax duty, and 60% is always available for your children or inheritance, whoever is taking the inheritance. That is the reason. And again, that applies only not on the US assets. It applies to the global assets because you are the citizen, you are the long-term resident, you are the domicile in the US. Then it is subject to estate tax. So we plan before we take the green card or a citizenship, we plan for our clients how to structure properly so we can mitigate the estate tax. Same thing that there is a gift tax. Okay. And remember, For an estate tax, that tax is levied on the person who is dying, okay, or whose estate is created. For a recipient, it is totally a tax free to us, okay. So gift tax also, whoever is giving the gift, they are subject to a gift tax. Whoever is taking the gift as a recipient, it never be a part of the income and they can enjoy that gift totally a tax free. But whoever is giving the gift and that person who is giving the gift is a US citizen or a green card holder, they are subject to a gift tax. Exclusion amount is given here. Okay, for the spouse, natural love and affection, anything is given to the spouse and the natural love and affection. There is the unlimited deduction. So if husband is dying and assets are moving from husband to a wife, if wife is dying and assets are moving from wife to husband, there is no estate tax. In the natural love and affection, if husband is giving the beautiful home or a beautiful car to the wife, there is no gift tax. Okay, anything from the husband to wife, it doesn't apply. But whenever things are moving outside that scope, if you are giving the gift to your children, it is subject to a gift tax. Okay, otherwise people are always smart, they plan. If I know I'm suffering from the big disease and then not next couple of days or couple of months I'm going to die, if I'm smart enough, I just give everything gifted to my children. Okay, that is the reason they come up with the gift tax. So tax is certain, whether it is a gift tax, whether all are the combined provision, whether it is a gift tax or a estate tax, it is subject to tax for the US citizen and green card holder. That is the reason you have to plan your US citizenship and the green card in the best way. If something is given to a spouse, there is no tax. But if something is going to your next family, your children, daughter, son, it is subject to taxation. For an estate tax, you have to file the form 706. For the gift tax, you have to file the form 709. Both are the very, very interesting section. Now, apart from that, okay, there is another layer of the tax, and that is called as the exit tax. I can ask Epi to move to next slide, please. Exit tax. Again, see, we all know all the CPAs and accountant are very smart, but the government is also smart, okay? So overweight, sometimes it might happen that I reach the 70, 75 age and I know that the next couple of years I'm going to die, and that is the reason let's surrender the green card. Let's surrender the US citizenship so we avoid this estate tax and the gift tax. To stop, okay, IRS is coming with the exit tax for the US citizen and the green card holder. So it is never be easy to exit as well, okay? So if you are decided to exit the US citizenship, relinquish the US citizenship or surrender the green card, you have to make sure you just file proper form and pay the exit tax. Limit is given here. You have to file the form 8854. Okay, everything you have to file with the IRS. Unless you clear the exit tax, IRS has a right to consider you as a resident for the tax purpose. Even from the immigration point of view, you relinquish the citizenship. Immigration point of view, you surrender the green card. Unless you pay the exit tax and file this form with the IRS will not allow you to exit from the estate tax and the gift tax liability. That is the reason the three provision. One is the estate tax, second is the gift tax, third is the exit tax, applies only to the US citizen, long-term resident, and the properly domiciled people. You have to plan those three taxes. These three taxes very, very carefully, okay? And there is a big tax planning is involved. But if your client is going through this process, you just make sure you guide your clients in the proper way. And this is a very, very interesting provision. I can ask the AP to move to the next slide. Still we have a 4 minutes. Okay. Yeah. And very good question. Okay. This is the good question. Again, the tricky questions. Let me see how the results are coming. Okay. All the best. Again, this is the funny questions. Okay, so you will also definitely enjoy with my answer as well.
Okay. They've started voting. So most of them think, okay, I think there'll be a tie again between A and B. So gift tax and needs to file form 709, or no gift tax since it is gifted to spouse.
Okay, still people are voting, and also
Yeah,
feel free to raise the questions. Okay, on our question answer session, I'm happy to answer after these questions. Then we are done. Okay, so just write the questions. Okay, if you have. So what is the conclusion, Epi?
they're still voting. They're
Okay,
still
let them
voting.
vote. Okay.
Yeah, there's gonna be a tie between A and B, I think.
Okay.
They're still voting.
Yeah, no answer for third or fourth, right?
Now fourth, some of them think that fourth is an answer, but third, they don't think.
Yeah, I always prefer the fourth answer. Anything is given in the natural love and affection, then think the gift tax. Yeah.
Then you see everyone, then everyone will say that it's natural love and should be exempted from the gift tax.
Yeah, but it's the government. They never cares about this kind of the factor. They just go with the paper. Okay, what is written in the book?
Yes. Okay, so some 43% of our attendees, they think that no gift tax since it is gifted to spouse, and 48% of them think that gift tax needs to be filed from form 709A. So most of them think it's A, the answer.
Okay, okay, excellent, excellent. Okay, this is really a good questions to understand the gift tax provision. And my answer is very simple, that the fourth one never be an answer, because it is not a part of the gift tax. Whether it is the natural love and affection or anything else, it is subject to a gift tax. Only thing that the very right answer is yes, it is subject to a gift tax and need to file the form 709. Okay, because the B answer is not a correct answer. Okay, just read the question very carefully. They just engage. Okay, they are not married. They were married in the February 2022. So on engagement, okay, since anything is given to the girlfriend or someone is recently engaged, it never considered as if something is given to the spouse unless you are legally married. Okay, so on December 2021, it is just the engagement ceremony. Okay, and this gifted the engagement ring valued the 50,000 USD. But it is not, it never be a considered as a given to the spouse. Okay, so yes, they are subject to a gift tax rule as like unrelated people. So right answer is the gift tax need to file the form 709. C is okay, not a correct answer. No gift tax since it is a social occasion, whether it is a social occasion or anything else. Okay, whatever is written in the law, that is final. So yes, the correct answer is the gift tax and need to file the form 709. B is not a correct answer. The reason is that on December 2021, when this is gifted to her, okay, she cannot be considered as a spouse. Okay, and my interpretation of this question, the moral of this question, which I learned, okay, don't give the costly gift at the time of the engagement. Please wait till the marriage. Okay, control your natural love and affection, and whatever you wanted to give, okay, give after the marriage, not before the marriage. Okay, thank you so much for your time, and I hope you enjoyed totally the international taxation issues, mainly on the US citizen and the green card holder. Recorded session will be shortly available on our YouTube channel, Smart Accountant. Thank you so much, Mansi, okay, for co-host this seminar with me. Thanks, Appy and the entire marketing team and the operation team for the great efforts. Next webinar, okay, the one webinar immediately after our 18th April tax deadline that we are coming with the how to create and how to plan the US incorporation. So if someone is planning the create their own company, own business setup in the US, mainly from the foreign country like India or any other country, what should be the right approach, whether they should create the LLC or INC, how they structure, state selection, in which state they should incorporate, how the FEMA and the RBI regulation will be applicable to them, everything that will be covering in our April webinar, that is the incorporation of US business entity, especially for the foreign person. Okay, thank you so much, entire team.
Vivek, we have a question.
Okay, yes.
It is foreign-owned US single-member LLC owner incurs expense on behalf of LLC business from personal account, whether required to be reported on 5472 or not.
I think that the 5472 will come into picture with the mostly the C Corp. Okay, so I generally believe that I assume that here the LLC make the check the box selection and the filing as a C Corp, and anything okay is between the related party has to be disclosed with the 5471. Since the business is foreign owned, so definitely 5472 is applicable. And this is considered as some kind of the reimbursement of the expenses. Okay, so on 5472 there is a line other payment received and other payment made. I generally prefer to report on those lines because not filing the 5472 will cost your client $10,000 penalty. Okay, so please disclose in the report. Any other questions, Abby?
No, that's for now.
Okay, excellent. Feel free to reach out to me if you still have any questions. If you view our webinar recorded session again, and if you still have any questions, we have our email address info@thesmartaccounts.com, and you have my company email address as well. Feel free to reach out to us and happy to answer your question. Those are the complex topics, but I'm very sure this will help you a lot in your day-to-day tax preparation. If you're practicing, definitely it will help you a lot to serve your client in the better way. Thank you so much. Okay, and have a good day if someone in the US, and a good night to someone in the India. Thank you so much.
Thank you, Vivek. Thank you, Mansi.
Thank you, Happy and team.
Very informative. Thank you so much. Thank you, attendees. See you soon.
Yeah, bye.
Bye.